video B now. Right, so once again, colleagues, welcome to video B of our FAC3764 lecture session here for the 2025, academic year. So I was explaining about the qualitative characteristics, and we were specifically looking at the enhancing qualitative characteristics. So I've mentioned about comparability, verifiability as well, understandability. Understandability simply means that you should be, the information conveyed in the financial statement should have meaning. And if it has meaning, it means somebody can be able to interpret what is being conveyed there. Also, that is if they are able to understand it. So you can only interpret something that you understand. So it must be understandable to the user. That's understandability. On a timely basis, that's why there's timelines by which financial statements should be produced and presented to the interested parties. Right. So I do explain, of course, in detail over these things, but I've already tried to explain to you at a high level, because I want to try and focus more on the elements of the financial statements. Right. So I've already explained about comparability, verifiability, I've already explained it, understandability, and then timeliness. Let's go on. Elements of the financial statement. So this is where the issue is, right? Or rather, this is the part you need to master the most. But obviously, I couldn't leave any stone unturned. That's why I had to explain the fundamentals of the conceptual framework. So all that we were discussing so far, it's all really the conceptual framework, right? And as part of the conceptual framework, there's elements of financial statements. So there are 5 in number, which is namely assets, liability, equity, income, and expenses. So let's quickly begin to look at the first one, which is asset as a definition. Asset can be defined. So these are the elements that I was talking about earlier when I was saying that you should be able to know the elements of an definition of an asset. So that, for instance, when you are explaining the first element, you say a present economic resource. A present economic resource meaning to say there has to be some form of rights that the company acquired as a result of a historic event, right? And it controlled by the entity. If it is under the control of the entity, that resource, if it's under the control of entity, it means that rights have been conferred to the organization from one party to the company or to the organization in question. And this is the resulting from past events. So in other words, there has to be a track record by which, or by when rather, the rights of the economic resources in question were conferred to the company. A result from past events, a right that has the potential to produce economic benefits. So the economic resource, look, it's basically the right that should be able to potentially produce economic benefits. The economic benefits, those are things like incomes. So for instance, I can acquire an asset in form of a delivery vehicle. Say I'm running a fruits and veggie company. So I would need certain type of assets or certain types of equipment in order for me to be able to generate my sales. So for instance, with a van, a delivery van, it's an asset by nature, right? So that delivery van, the moment I acquire it, right, I would get a right of ownership on that particular van. Why? Because I'm able to control where that van should go, at what time, and what goods it should be carrying from the shop to the consumer, right? But look, at the end of the day, when I begin to do deliveries for the fruits and veggies that I'm selling to my consumers, it would result in me generating sales. That sales is what we can regard as economic benefits. So assets are meant to produce economic benefits to us as a business entity or even as an individual. That's an asset for you. So far, so good, sir?
Yes.
Right.
Still on board.
Yeah. So I was just trying to explain these guys at a high level, just so that you understand what you're going to be looking at. So, but I'm going to explain each element individually so that you clearly understand what's going on. So when you're saying something is a present economic resource, it simply means it is a right that has a potential to produce economic benefits for the business entity. So that's why an asset is considered as a what? Present economic resource, a present economic right, right? And that right is either right for you to receive it as cash or right to receive as goods or services, or it can be right. So this is just examples of types of assets, or rather, yeah, the nature in which assets can come to you as the recipient. So in form of a right, so it can be either in form of cash, it can be in form of you having to receive goods or services, or it can be in form of you having the right to use the asset or even to sell it if you choose to. But essentially, at the end of the day, there has to be some form of ability of that right to generate or to produce economic benefits to you. That is what qualifies it as a present economic resource. So when you're looking at a transaction, you're looking at those things to say, okay, the transaction in question that we are dealing with in the context of the question, does it have something to do with the company having a right, either having received money, right to have received, maybe it's in form of goods, physical goods that have monetary value, or receiving a service, or does it come in form of the right to use the asset or to even sell it, by the way? Think about shares. So you can opt to sell your shares, or you can opt to use the shares. In other words, keeping them to accumulate in value. So assets come in different forms and in nature. Some they are not physical in nature per se. Like for instance, if you think of shares, you cannot hold a share, like physically, so to say, yeah, this is my shares physically, and you put them to us like this. No, there has to be some form of a legal document which would prove your right to own certain shares in a particular organization. So those are the dynamics that you need to look at, which suggest that there's a present economic resource in question. Number two, the economic resource should be controlled by the entity, meaning to say that the entity should have the ability to direct the use of the economic resource and should also have the ability to obtain benefits that flow from the resource. Now, think about a trust. So a trust can be receiving money, that's assets, right? They can be receiving money from their trustees. That money they are receiving, it's not for their benefit, it's for the benefit of their trustees. So we cannot then qualify or quantify that money as the assets of the business per se, because it does not belong to them. Does it make sense?
Yes, it does.
Yeah.
It makes sense.
Yeah. So it's very important. So with the issue of control, it's about just it has much to do with the ability to direct the use of the economic resource or to obtain benefits that flow from the resource. Number three, resulting from past events. So this basically refers to a date on or before the reporting period of the business in concern. Very important. So if something is considered a past event, it means it is an event that has occurred before the actual date of reporting for that company in question. So let's say the company's financial statement is closing on the 30th of June, 2025. And we have a transaction that occurred in January 2025. That event that took place in January the 30th, for example, it's a past event. Why is it a past event? Because we have not yet reached our reporting date for the current financial period of the company, which is 30 June 2025, for example. That's the dynamics about past events. So it's much to do with dates. Then we go to liabilities by definition. But before we do that, look, there are different types of assets, my brother. They can either be non-current and they can also be current assets. I'm sure you are familiar with that.
Yes.
So that's one of the reasons I did not decide to explain and break it down, because these are things you learned at first year in terms of types of assets. But let's look at liabilities on the other hand. Liabilities by definition well, they're also classified into two groups. There's non-current liabilities, and then there's your current liabilities. But essentially, with the liabilities, it's basically a present obligation. Notice assets. What did you say about assets? Assets are present economic resources. Present economic resources. So it's something that's there now, but which is going to produce economic benefits to the company. That's an asset. Whereas with a liability, it's a present obligation. So we are owing the credit or the debt to a creditor or a lender today. And what would happen at the end of the day is that it will result in a transfer of economic resources or outflow of economic benefits, basically. Anyway, but yeah, so it's a present obligation of the entity to transfer an economic resource. So it can be to transfer money as a payment or to transfer something, whether in what is it? Whether it's a car. Let's say when you buy a car on finance, right? The moment you enter that agreement, right? But of course, to them, yes, it's going to result in revenue. But before they deliver that car to you, there will be that present obligation for them to give it to you. But yeah, don't worry about that example. I'm just trying to say, look, a present obligation means that there is a part that has to be played by the party which owes the other part. Right. So it's a present obligation of the entity to transfer an economic resource as a result of past events leading to a duty or responsibility that an entity has no practical ability to avoid. So if in a case where a company has obtained a loan from the bank, they would have to pay, or they would have to transfer the economic resources to settle their account. But let's explain all these elements in a greater detail. So, oh, sorry. Wait, did I skip this one? Because there's supposed to be another slide where I'm explaining each element, but it's fine. So let me just summarize it here verbally in the party. So a present obligation, it means you are obliged to perform or to meet up a certain condition. But that condition, or to perform a certain action, it would result in transference of economic resources. When you have such a case like that, it means you're dealing with a liability. And usually it will be because there's been a legal agreement that was actually established in the past, which has resulted in this present obligation having to be raised against you as an entity to transfer the economic resources to the third party involved to the legal agreement that you had in the past. And usually it's a case whereby you might not, or you would not be having practical ability to avoid, you would, since you entered into the agreement. So for instance, if you obtain a loan from the bank, look, practically what you need to do is to pay them. You can't avoid not to pay them. The moment you're avoiding to pay them, you're violating the agreement or contract that you would have had, or that you would have entered to with them. So in essence, that's a liability. And equity, by definition, is basically a residual interest in the assets of the entity, meaning it says the difference between assets minus liabilities. So that's what gives us equity. Does it make sense, sir?
Yes, it does.
Yeah. So that's what equity is by definition. Incomes, on the other hand, it increases in assets. So when you see assets increasing, that can be implying income to the business. So it's an increase in assets or decrease in liabilities, but not just other than those relating to contributions from holders of equity claims. Other than those relating to contributions, in other words, equity or money received as a result of money coming from as a result of capital contributions, that cannot be considered as income to the business. All right. That cannot be considered as income to the business. But when we see assets increasing, assets can increase because of revenue coming into the business. Assets increase when we see liabilities being settled, in other words, being reduced. That gives an increase to the value of your assets as a business entity. Right. And then last but not least, it's your expenses. So expenses, it's the opposite of incomes. So it's usually a case where assets are decreasing and liabilities to the contrary increasing. But notice it has nothing to do with distributions to holders of claims. So in other words, drawings cannot be considered or regarded as an expense. Does it make sense?
Yes.
Yeah. Drawings, it's just basically distributions to holders of equity. All right. It's not an expense. That's why you don't find drawings in the statement of profit or loss and other comprehensive income. Right. So what we're going to do, but not today, this will be a discussion during the course of the week. I'm going to bring some practical questions, which we are going to discuss over this. So those practical questions, it can be in a case of a question I'll bring from a year test. It can be a question that I can also take from the textbook itself, and then we discuss it in our class. So the first part of the session next week, I'll be dealing with this. And then the second part of the session, I'll introduce a different concept altogether. That's what we're going to do next week. So I think at this point, we have come to the end of our session for today.
All right.
Yeah. I hope this was fruitful to you.
No, it was.
Wonderful.
It was.
Wonderful. I don't know if you have any questions, clarities that you require.
No, not at this moment. I'll go through it again, and then in the week when we meet up again, if I have any questions, and then I'll ask you.
Okay. No.
Yes.
That would be brilliant. That would be brilliant. Thank you so much, sir. Thank you for your time.
Okay, thank you. All right.
I'll upload the recording